Can you trust a platform where AI agents automatically manage capital and generate profits through spread arbitrage on Polymarket? To find out, I first tested the platform with a small amount of money. The very first thing I wanted to verify was whether the funds were not only reflected in the account balance, but could actually be withdrawn. After several successful withdrawals, I decided to increase my deposit. At the moment, I have more than $12,700 invested in the system, and my total profit has already approached $2,000. However, the main question for me was never the returns. What interested me the most was where this money actually comes from, how the AI agents operate, how the company itself generates revenue, and what risks are associated with this model. In this video, I'll take you behind the scenes of the platform, explain how arbitrage on Polymarket works, show real deposits and withdrawals, and explain why, after testing the service, I decided to increase my investment to a 5-figure amount. The platform is called PolyGate. Its purpose is to automatically identify profit opportunities on Polymarket. Here's how it works in simple terms. On Polymarket, you can buy different outcomes of the same event. For example, yes and no. Once the event is resolved, these two outcomes should collectively be worth $1. However, due to market pricing inefficiencies, there are times when both positions can be purchased for less than that amount. When this happens, the automated agent buys both outcomes and captures the price difference as profit. The agent doesn't need to predict whether Bitcoin will rise, Ethereum will fall, or how a particular event will unfold. Its job is to identify suitable pricing discrepancies and execute trades as quickly as possible. According to PolyGate, these AI agents operate around the clock, continuously scanning markets and automatically placing orders whenever opportunities arise. Returns can reach up to 1% per day, but this is not a guaranteed or fixed result. On some days, profits may be higher, lower, or absent altogether. Performance depends on market activity, available liquidity, and the number of arbitrage opportunities available at any given time. On the home page, you can see a terminal interface where the agent connects to Polymarket, analyzes market conditions, and execute trades. Next, let's take a closer look at where these price discrepancies come from and how the system generates profits from them. Polymarket is a platform where users trade on the probability of various events occurring. Each event typically has two possible outcomes. Yes, meaning the event will happen, and no, meaning it will not. The price of each outcome changes continuously based on how likely market participants believe that outcome is. Once the event is resolved, the correct outcome becomes worth $1, while the incorrect one becomes worth $0. Let's look at a simple example. Suppose an agent buys yes for 52 cents and no for 47 cents. In total, the agent spends 99 cents. At that point, it doesn't matter how the event ultimately turns out. One of those two positions will always be worth $1 after the event is resolved. That means the agent spent 99 cents and receives $1, generating a profit of 1 cent from the price difference. The profit from a single transaction is relatively small. That's why the system continuously scans the markets, places a large number of orders simultaneously, and constantly searches for new opportunities. On the website, this process is divided into 3 stages. First, the agent places the order on both sides of the market, yes and no. Next, it waits for both orders to be executed and captures the pricing spread. Finally, the algorithm immediately begins searching for the next opportunity. Users do not need to select events, monitor prices, calculate spreads, or manually place orders. All of the technical work is handled automatically by the system. At first glance, the concept seems fairly straightforward. That naturally raises an important question. Why not simply go to Polymarket and execute these trades for yourself? The main challenge is speed. Profitable pricing discrepancies may exist for only a few milliseconds. By the time a person notices the opportunity, calculates the combined cost of both positions, and places the orders, the prices may have already changed. According to information provided by PolyGate, a typical trading window lasts between 10 and 50 milliseconds. The platform states that its agents operate with latencies of approximately 2 to 5 milliseconds. For comparison, a standard VPS may experience delays of 40 to 80 milliseconds. A home computer can range from 150 to 300 milliseconds. And manual execution by a human trader takes several seconds. As a result, the value of the project goes far beyond the arbitrage concept itself. Success depends heavily on the underlying algorithms, server performance, infrastructure placement, order management, execution monitoring, and the ability to operate across multiple markets simultaneously. PolyGate utilizes multiple independent agents. Each agent runs on its own server and can focus on a specific market, such as Bitcoin, Ethereum, or XRP. This allows the system to monitor multiple opportunities at the same time and react immediately when a suitable pricing discrepancy appears. Building and maintaining this kind of infrastructure independently would be both technically challenging and expensive for most users. The next section of the website shows the markets in which the system operates. At the time of recording, the available markets include Bitcoin, Ethereum, and XRP. Within each of these markets, the agents continuously monitor prices and search for suitable pricing discrepancies between orders. For example, in the Bitcoin market, the system currently works with 5-minute and 15-minute prediction markets. The number of opportunities depends largely on how active the market is. When prices move more rapidly and participants execute more trades, temporary pricing inefficiencies can occur more frequently. However, that does not mean returns will be the same every day. On some days, the system may identify a large number of suitable opportunities, while on others, there may be significantly fewer. In addition, some orders may not be filled at the desired prices. For that reason, performance should be evaluated over a longer period of time rather than based on the results of a single day. Now, let's take a closer look at how PolyGate itself generates revenue. The project earns a commission from the profits that its system generates for its users. For example, if you deposit funds into the platform and the arbitrage agents generate $100 in profit, $80 goes to you, while $20 goes to PolyGate. It's important to understand that this commission is not charged on your entire deposit. It's charged only on the profit generated. In other words, if you deposit $10,000 and the system earns $100, the commission is calculated solely on that $100 profit. As a result, PolyGate only earns money when its users earn money. If no profit is generated, the project does not receive a performance-based commission. This creates a strong incentive for the team to make the system as efficient as possible, identifying pricing discrepancies quickly, executing trades at the right time, and expanding into newer markets whenever opportunities become available. But why is PolyGate constantly attracting new users? The more users join the platform, the more capital becomes available for arbitrage opportunities. In theory, this allows the system to execute a larger number of trades and potentially generate greater overall profits. However, there is also a practical limitation. Markets don't always provide enough profitable opportunities to absorb unlimited amounts of capital. Every strategy has a certain capacity limit. Another reason is the development of the platform's broader ecosystem. Today, users primarily join for access to an automated arbitrage solution. They don't need to build trading algorithms, rent servers, or connect to multiple marketplaces themselves. In the future, the same user base could be offered additional strategies, new markets, and other investment products. From PolyGate's perspective, users provide several important advantages at once: additional working capital, commission-based revenue, an active community, and a foundation for launching future products. Another important metric displayed on the website is the maximum amount of capital the platform can effectively manage. At the moment, that limit is set at $5 million. At the time of recording, users had deposited approximately $741,000, leaving roughly $4.3 million of available capacity. Why does the platform limit the amount of capital it accepts in the first place? The reason is that arbitrage strategies require a sufficient volume of suitable opportunities in the market. If too much capital is allocated to a single strategy, there may not be enough profitable trades available to efficiently deploy all that money. When that happens, the effectiveness of the strategy can decline and overall returns may be reduced. To avoid this problem, PolyGate establishes a predefined capacity limit. The logic is straightforward. It's better to accept a smaller amount of capital and use it efficiently than to attract excessive funds and potentially reduce performance for all users. This approach is designed to help maintain the effectiveness of the strategy while balancing available capital against the number of profitable opportunities in the market. At the bottom of the website, there is a frequently asked questions section. Now let's move to the dashboard and see how it's structured. The main page displays the total account balance. Below that, you can see the funds in the wallet and the amount that is currently working in the pool. The deposit and withdrawal buttons are also located here, so all key actions are available in just a couple clicks. On the right, there's a profitability chart for the last 30 days, and below it, you can view the history of all transactions, deposits, withdrawals, and profit distributions. In the My Earnings section, you can see income statistics for the day, week, month, and the entire period. Essentially, all the key information is available on a single screen. How much capital is working, what results have been achieved, and how the balance has changed over time. Like most people, I wasn't planning to deposit a large amount right away. To start, I funded the account with around $100 and simply began observing how the system worked. I wanted to understand how profits were credited, how consistently the platform operated, and whether there would be any issues with withdrawals. After some time, I increased the deposit slightly and continued testing. Once the account showed its first profit, I decided to not take any chances and immediately test the withdrawal process. I submitted a withdrawal request, and the funds arrived without any issues. After that, I made several more withdrawals at different times. For me, this was the most important part of the evaluation process because any project can look good right up until the moment you try to withdraw real money. Once I confirmed that withdrawals were actually working, my perspective on the platform changed completely. After several successful withdrawals, I decided to move beyond testing and start working with a larger amount of capital. First, I deposited more than $10,000. After monitoring the results for some time, I added another $2,200. So this was not a spontaneous decision. I didn't deposit the entire amount on day one. The size of my investment increased gradually as my confidence in the system grew. At the time of recording this video, the total account balance exceeds $12,700 and the profit earned is approaching $2,000. I periodically withdrew part of the profit while leaving the rest to continue working in the system. For me personally, this approach seems the most reasonable. First, test the platform with a small amount. Confirm that withdrawals work as expected, and only then consider increasing the size of your deposit. There's also a 3-level referral program available in the dashboard. You earn 15% from first-level referrals, 5% from second-level referrals, and 3% from third-level referrals. It's important to note that the reward is calculated not from the referred user's deposit amount, but only from the profit they generate. Let's look at an example. Suppose someone registers using your referral link and deposits $10,000. Over the next 60 days, they earn $4,500 in profit. If this is a first-level referral, your reward would be 15% of their profit, which equals $675. At the second level, with a 5% rate, the reward would be $225. And at the third level, with a 3% rate, it would be $135. This means the referral program allows you to earn additional income from users who register through your link and generate profits within the platform. This may be particularly interesting for owners of blogs, channels, and other platforms with an audience. In addition to its core yield generating strategy, the platform is currently launching its own points program. Users receive special points for their activity within the ecosystem. These points are awarded based on deposit size, how long funds remain on the platform, participation in the referral program, and the completion of various tasks. In other words, the more capital you have working in the system and the longer it remains on the platform, the more points accumulate in your account. For example, my account has already accumulated more than 17,000 points, and that number continues to grow every day. The main idea behind the program is that these points may eventually qualify users for an airdrop of the platform's native token. In practice, this serves as an additional incentive for early users. Alongside the returns generated by their capital, they may also become eligible to receive a distribution of project tokens after the token launch. Of course, the exact details of any future airdrop, the token launch timeline, and the token's market value are still unknown. However, if the platform follows through with this plan, the accumulated points could become an additional source of value on top of the platform's primary returns. The project also has official pages on Twitter and Telegram. On Twitter, the team publishes platform updates, service news, and information about future development plans. Telegram, you can follow announcements, read discussions, and communicate with other community members. I'll leave links to the Twitter account, Telegram channel, and the platform itself in the video description. To sum it up, the most important factor for me wasn't the attractive promises or the percentages shown on the website. What mattered most was being able to test the system in practice. I started by testing the platform with small amounts, then successfully completed several withdrawals, and only after that increased my deposit to more than $12,000. At this point, the account has generated nearly $2,000 in profit. And so far, I don't see any reason to stop putting my capital to work. At the same time, there are two potential sources of returns here: the primary earnings generated by the strategy itself and the points program, which may eventually provide eligibility for an airdrop of the platform's native tokens. What's particularly interesting is that opportunities like this typically exist during the early stages of a project's growth. As more users join the platform and more capital is allocated to the strategy, the available capacity gradually fills up. So if the project has caught your interest, I wouldn't put off looking into it. You can find the link in the description below. Take a closer look at the platform, review the terms, observe how the system operates, and decide for yourself whether this type of opportunity is right for you. In any case, it's better to understand it now than hear about it a year from now when the most attractive opportunities may already be gone. Good luck.